Hi everybody, this is Alan Ellman, the Blue Collar Investor. In today's video we're going to discuss a mid-contract exit strategy I call hitting a double. That's where you sell an option, buy it back in the same contract cycle when the stock drops in price, and then resell that very same option in that very same contract cycle, thereby generating a second flow of cash. Now, when I discuss exit strategies, I break them up into two categories: those prior to Expiration Friday and those on or near Expiration Friday. Hitting a double falls into the first category, prior to Expiration Friday, or in the first half of the contract cycle. Other exit strategies prior to Expiration Friday include rolling down, where we buy back the option and sell a lower strike in the same month; hitting a double, which is what we're going to discuss in this video; unwinding your position when the strike price falls deep in the money. That means the price of the stock has gone way up, leaving the strike price very much deep in the money. And what happens in those situations, the time value of the option premium basically disappears or approaches zero, allowing you to buy back the option, sell the stock at literally no cost to you. Then you could take that cash to enter a new covered call position, thereby generating a second flow of income with the same cash. And finally, we have converting dead money to cash profits, which is where we've basically had it with the stock and we just unwind our position and use the cash to enter a new covered call position. But today we're going to discuss hitting a double, which is a bullish exit strategy. And all of these strategies start off with the very same first step, which is buying back the option. Other factors we consider when entering covered call exit strategy positions is we will consider buying back the option at 20% of the original premium sale in the first half of the cycle. And this is just basically a guideline that I've developed to give you an idea when the best time would be to buy back an option, or 10% in the second half of the cycle. Now, if a stock has had bad news attached to it and is dropping precipitously, you could buy back that option at any price to exit your position. We also look at market tone. If the general market conditions are very favorable, I'm more likely to enter a bullish exit strategy. And finally, we also look at the technicals of the underlying security. Now, first I'm going to show you an example of hitting a double, which is taken from my second book, Exit Strategies for Covered Call Writing. And I usually do multiple contracts, but for purposes of explanation, I'm going to break this down into one contract. So on October 20th, I bought 100 shares of BLUD at $23.80. Now that's on the left-hand part of the chart here. And you'll see that what will happen is the stock will drop down in price, and after it drops down in price, it will go back up again. So on most of these successful hitting a double strategies, you'll see this V-shaped pattern on the chart. Okay, so I sold the $25 out of the money call, and that generated a profit of $110 per contract. When the stock went down in price, or the bottom of that V, I bought back the option at 20 cents, which met my 20% guideline. And then I resold the very same strike in the same contract period when the stock went back up on October 30th. I sold it for $1.70. So if you take the $1.70 and subtract the 20 cents to buy back the original option, that's a profit of $1.50 per share, or $150 per contract, by instituting this hitting a double exit strategy. Now, in the next example I'm going to show you for Blue Coat BCSI, you'll see that very same V-shaped pattern. The blue arrow starts when the stock price is above the 20-day exponential moving average, and then it dips down below, and then the red arrow shows you the stock coming back up again. So there again you have that beautiful V-shaped pattern that allows us a successful hitting a double exit strategy. Let me break down the exact numbers that I did back in October of 2009. On the 26th, I bought 1,000 shares at $25.35 and then sold the slightly in the money or near the money $25 call at $1.35. Now when I compute my profit, I deduct the intrinsic value, which means that since I bought the stock at $25.35 and agreed to sell it for $25, I'm going to actually lose 35 cents per share when the stock is sold. So I don't include that 35 cents as profit. So my profit is knocked down from $1.35 to $1. When you subtract the small commission, it comes out to a profit of $992 on the sale of the first option. Now, when the stock dips down on the 30th, I closed my position by buying back the 25 calls at 25 cents. Okay, and then when the stock went back up again, I was able to sell that exact same 25 call for $1.15. So if we take the $1.15 and subtract the 25-cent profit, and we subtract that from the additional cash generated from the second sale, we now have a second income stream of $868. So the two income streams of $992 and $868 totals $1,860, which represents a 7.4% one-month return. Had we not instituted this hitting a double exit strategy, our one-month return would have been about half that amount. So once again, I just want you to look at the chart. This is what you're looking for, that V-shaped pattern where the stock dips below the 20-day EMA and then comes back up again, allowing us to generate that second income stream. So to summarize, we must learn and master all exit strategy opportunities. And I call it an opportunity because it will allow us to generate more cash into our account or reduce our losses. And we also must be prepared to institute these strategies when indicated. And if we do learn and master these strategies and we are prepared, we will then maximize our profits and minimize our losses. So I hope you folks found this video useful. You can get more information at my website, thebluecollarinvestor.com, or feel free to email me directly at alan@thebluecollarinvestor.com. Thanks so much for taking the time to view this video. I look forward to hearing from you in the near future. Take care, everybody.